I've been investing for a long time, but I've been a real fund manager for these 3 years. I guess the big things that have been impressed upon me are that there's always going to be someone smart who hates some of your favorite ideas, and you just need to be comfy with that and have a thick skin. It's important to hear out other people's views, and you need to have humility around your best ideas, but at the same time, you have to have conviction when you think that you're right. The other thing is, you really can't understate how obsessed with short-term performance most people are in the market. Brokers are, fund managers are, analysts are judged based on short-term calls, and it all just feeds on itself. But if you're able to step past that and operate on a different time horizon, I think that's where you can create one of the biggest edges in the market. I've always been a big believer in backing your best ideas. It suits my temperament. I've never felt like I would be doing right by investors by putting money behind my 50th best idea. And when you look at empirical research, it shows that on average, managers that are higher conviction outperform those that are lower conviction, which makes sense for probably the same intuitive reason. The biggest risk with being high conviction is that when you're wrong, you feel it. But at the same time, I find that part of the appeal, which is that if we're right, you feel it. And if you back yourself and you're good at what you do, then you're driving value, and why not back your best ideas? But I think an ironic, people would look at it and say, well, you're probably going to have higher short-term volatility as well with a higher conviction strategy. Your active share is going to be higher, your tracking error is higher. But ironically, I think what happens is if you have a low conviction, no one ever puts it low conviction, but let's say you have a low tracking error strategy, you look very similar to your benchmark, you have low active share. In the short run, you're going to have much less volatility, and investors like that. When you go out over a long time horizon, though, your performance is probably going to be pretty ordinary. And there's a reason that a lot of really low conviction funds have performance that looks a lot like the benchmark minus their management fee. Because that's more or less what you end up looking like over time. So, I just think it's important for us to focus on actually trying to add value and do something different, and I think the data supports it. You just have to go out and actually execute on it. Our core investing fascinations are IP, loyalty, and networks. And where that kind of came from was that when we actually built out a proper sized team, as CIO, I had the question of, well, how do I want to focus our team? And the traditional way of doing it is, well, we're going to allocate based on sectors. So you'll have an IT person, a mining person, et cetera, or geography. So, all right, well, you'll get North America, you get Asia. But the reality is that these markets aren't all created equally. Some of them are more hospitable to outside investors than others. And not all these sectors are created equally. So you've got some industries that historically have high and consistent returns on invested capital, which if you're a long-term investor is really attractive. On the flip side, some of them are, and like enterprise software would fall into that, consumer would fall into that. Then at the other end, you've got cyclical and low returns on invested capital. So cyclical would be almost everything in materials. Utilities have very stable returns, it's just that they're terrible. So as I was thinking, well, how do we actually want to focus our time and effort? It was more around, well, what are the economic models that we think drive long-term outperformance? And these are the things that we're fascinated by and care about, so let's focus our efforts around that. So we have Puja focused on IP and trying to find businesses that have unique and enduring forms of IP. And that can be across any sector or form factor, but something that's durable. Irwin covers networks, same thing there. And you think networks, you think payments, stock exchanges, social networks, and utilities. But developing a deep expertise around network effects and the nuance around them. We find that the phrase network effects gets thrown around really cheaply these days, but the reality is there aren't many companies that have powerful and valuable network effects. And the third is loyalty. So just having a deep understanding of the unit economics of businesses that are all about loyalty-driven models. So lifetime value relative to customer acquisition cost, and developing our own tools around that and a degree of sophistication. So it's just the things that we're fired up about as investors, and that from a bottom-up process, we're trying to find businesses that have those models. We don't find it all that daunting for a few reasons. The first is that we're high conviction, low turnover investors. So we're only looking for a handful of new ideas a year. So that narrows things down pretty considerably. The second is that we're really only looking for businesses that have a form of unique enduring IP, network effects, or extremely loyal customers. When you kind of narrow that down and you're not trying to cover all the waterfront, but you go from here to here when you're looking for those qualities. And the third thing that I think actually plays really well to our strengths, combining a global focus and Aussie smalls, which traditionally you wouldn't think go together, is that we spend a lot of time on software and the ecosystems around them and consumer as well. And so when you're looking at Aussie smalls, what I see happen sometimes is people will look at a listed company here and they look at it in a very narrow sense of what it's doing here in this market. But you can't really have an informed view about software ecosystems without looking at what Microsoft's doing, what Amazon's doing, Google, and all the large global competitors in the SaaS space. So I feel like if you're kind of swimming with sharks if you're investing in Aussie smalls and you don't have a global view with software and the ecosystem around it. And so for us, I actually think it's a relatively strong advantage combining the two. The fun thing with having a global mandate is that it's such a broad canvas and they're all types of companies. And you can get truly world-class in that sense. That said, Aussie Smalls is still really fun, and there are a lot of small companies there that they're growing quickly, they're gaining share. They may not be world-beating companies. In some cases, when you take an Altium, it's gaining share at global scale. You take an Afterpay, which is obviously thriving in the US, expanding into the UK. But there are plenty of companies that they may not be world beaters, but they're still creating a lot of value for investors. And a lot of those are really fun and exciting for us to follow, and especially just at a younger point in their growth cycle. They're higher risk as a result, but when it works out, it can be really rewarding. I think there's some really exciting companies in the IT space within Australia. A lot of them aren't exciting, and I think you have to be really discerning. And I think a big difference in what you're looking at is there truly a global opportunity for this business, and is it solving a problem, and is solving in a way that can scale? The reality is most of them aren't. So either they don't have product market fit, or it might be solving a problem, but it's a localized problem, and that's not going to be able to scale out. If it is just a localized problem and specific to Australia, then you need to be pretty tight and disciplined about the price you're paying, because that company's not going to be able to grow into a market that's 13 times larger. For companies that can do that, I think they're definitely worth a significant premium. And you look at an Altium, you look at an Afterpay, they've managed to do that, and they've grown into much bigger markets and succeeded in doing so. Those companies are never going to be classically cheap, but that doesn't mean that they can't add a lot of value. And I think that so long as they're able to keep progressively scaling into new places with attractive economics in a disciplined way, then those kind of businesses are definitely worth a premium. I think Altium's got a really bright future. And if you look at the past few years, the last 3 fiscal years, the revenue accelerated. They posted mid-30s EBITDA margins, even though they expense all of their R&D, which for anyone who gets into the gobbledygook of how accounting works with software companies on the ASX, typically companies will capitalize so that doesn't go through the income statement. It's all a roundabout way of saying that Altium is probably more profitable relative to other software companies than the income statement would suggest. Even you look at the last 2 years, new seat growth for Altium Designer, which is their flagship product, has accelerated. They've got really tight cost controls, and I think that when you look at it, a business that pays out something like half of profits as dividends, but is still able to grow its top line in the 20s, that's a really rare feat. You don't see that very often. And I've always felt like that was just a simple calling card, that something was going really right with the business. And when you look at the acceleration in new seat sales, plus their cloud product is getting traction, has key reference clients now, and they're trying to solve for this pain point between manufacturers and designers. It's a bit of a long story short, but they're trying to create a solution, a marketplace where they can connect idle capacity for manufacturers with people who want their circuit boards, the ideas, what they've designed and created, to actually be printed in a low stress, low cost way. They're trying to solve for that if they can. I think that's a really big opportunity. But I consider that a nice to have call option just on top of the core product, Altium Designer, which is gaining share against stagnant competitors, has flexed pricing power, and yet has increased renewal rates over the past several years. And you got a management team with a lot of skin in the game that's executed really well. I think growth investors need to be a lot more discerning right now than they have in the past, largely around valuation. There are always pockets of opportunity in every market, and we're finding some companies that we're really excited about that we think offer a lot of attractive organic growth at good economics with a long runway, good balance sheet, at good prices. But I can point to plenty that we'd struggle to wrap our heads around the valuation. So Zoom is a business that we absolutely adore. We use the product. It has great unit economics, inherently viral, founders deeply engaged. I have nothing critical about the business really to say. In fact, I actually think it's much more durable than most analysts think. But when you look at the price, it's hard for us to find a base case valuation where investors are going to get something like a double-digit return over several years. And I struggle to get excited to back something where we're not going to get that kind of profile. So even though we're very growth focused, we don't swing at every pitch. That said, if you look at to go to Facebook, it's growing at 31% Forex neutral terms, which is pretty remarkable, but only selling on 22 times forward estimates. For context, you look at Procter & Gamble, it's growing 3% and selling for 24 times forward earnings. And I think what's happened is you have a lot of really high growth names that are really, really expensive, but then you also have some almost like bond proxy like investments like P&G or utilities that have gotten really dearly priced themselves. And you can have situations like Facebook where I think there's a really wide range of opinions on the business quality. But that's a good thing, because when there's a wider range of opinions, there's more room for you to add value through analysis and having a different perspective. There is such a wide range of what can happen. And there are plenty of people who invest in growth companies who, if I'm being honest, they're not very sophisticated about it. They just look and see, oh, well, this is a high growth rate, so I'm going to buy it. Well, it doesn't always work like that. I think you need to be sophisticated about, well, how able is the company to maintain those rates of growth? Are they able to do it on economically efficient terms? Are they able to cross and upsell within that? Can they roll out new products? Do I trust that the team running this has incentives that are aligned with creating high quality growth? And oftentimes that's not the case. So you have to be really discerning about it. But again, I think that's part of the fun, and I think that's where you can add more value in a way that's tough to factor. It's surprising how few of these companies have rigorous capital allocation frameworks. And I know that's not necessarily the most exciting thing to talk about, but the reality is a lot of people, CEOs, CFOs, they're all smart. You don't end up running a listed business without being a smart cookie. But there's a big difference between being smart and being a strong capital allocator, which is a role and a position that people aren't really thrust into until they're in that position. But what we'll find oftentimes is that companies don't really have a good handle on their incremental returns on invested capital. So, how much are you spending to acquire a customer? What's the lifetime value of that customer? What is the level at which you think you're adding value, and where's your threshold when you don't? When you make an acquisition, what kind of returns are you looking to get off that? We oftentimes find companies can be a little loose about their standards, and I think those are situations where they make splashy deals and everyone feels excited, but years later it ends up being disappointed, and it's because they put a lot of money behind growth, but it was low quality growth. We get excited about businesses that are really analytical about how they reinvest into the business, and they have clearly defined hurdles. And at the unit level, they know, look, this is how much we can pay to acquire a customer. If we're not doing better, we can only spend up to that level. And we need to hit the gas when we can, get above that, but if not, we're going to tap the brakes. That kind of rigor and discipline is actually surprisingly hard to find, and we do get excited when we find it. I think it's a lot tougher question than a lot of value managers. I don't think they're going to like the answer. So let's just, for a minute, step beyond the Buffett thing where we agree that growth and value are joined at the hip, and let's just all say we're enlightened and agree with this point and move on. I think if you look at a continuum of pure statistically driven value versus pure qualitative growth, I think the reality is that if you've been living on this end of the spectrum where your whole deal was we buy statistically cheap stocks, 30 to 40 years ago, when people didn't have access to the same information and trading costs were really high, that might have been a way to add a lot of value. Today, where information edges have gotten a lot lower, there's a lot less friction in trading costs. That's a strategy that is easily factored in a quant strategy, and there are all kinds of ETFs that just go out and buy statistically cheap stocks. So if that's basically been the crux of your alpha proposition for a long time, I think you kind of need to look in the mirror and ask, what is it that we're adding that a well-designed, low-cost ETF can't solve for? If you go to the other end of the spectrum, growth, and now historically value has outperformed growth. So on the one hand, you've got that going for you over a very long time horizon. The thing is that on the growth side of the equation, because it's more qualitatively driven, and you're oftentimes dealing with business models that people haven't seen before and there's not a blueprint for, there's a wider dispersion of returns, which on the one hand means there's a higher probability that you get your butt handed to you, but it also means that there's more room to add value through qualitative analysis and having a longer time horizon, because those things are harder to factor. And there's just a much wider range of opinions on how things can work out. So when you're right in a much bigger way, whereas if it's something that more or less everyone can agree on what the economic model is, and the question is just, well, should it sell at 16 times instead of 14 times earnings, it's hard to really move the needle on performance. So, as we think about the range of outcomes going forward, value's had a tough time. In cyclical terms, I wouldn't be surprised if it bounces back. But in secular structural terms, I feel like people relying on just buying statistically cheap stocks are going to be struggling over the next 5 to 10 years. Facebook and Alphabet, the big tailwind behind it is that there's just more dollars going into online and digital advertising. And the reason that happens, one is, you've got more eyeballs behind it, but two is companies and marketers are tired of spending money and not knowing what the ROI is. So if you put up a billboard on the side of the road, it's really hard to measure the value of that. You don't know who saw it. You don't know how many people saw it. You don't know what they bought, when they bought it, why. And that kind of marketing spend is getting a lot harder to defend these days than it used to be. It's much more attractive to go to a Facebook or an Alphabet platform, and you could be talking, core Facebook Blue, Instagram, YouTube, Google Search, Google Display, any of those, and you have a much better handle on, well, this is exactly what it cost me for someone to see this, and I can trace and get a good sense of whether or not they actually bought something, and I can see the lifetime value of this customer. So as marketers get more discerning about ROIs, they, as the two biggest platforms outside China, are far and away the biggest beneficiaries of that. They have unmatched data on customers. It would be really hard for someone to come in and replicate the treasure trove of insights that they have. Now, that kind of leads into some of the biggest risk, and the biggest would be regulation. So it's no secret that it's a big political hot potato in the States, a discussion of breaking up Facebook, breaking up Alphabet, and even Amazon as well. For each of those, I would just say the hill to climb on proving consumer harm is a lot harder than it sounds. So in the US, the way antitrust works is, are consumers harmed by this business being together? I think it's hard to prove that Facebook owning each of Facebook and Instagram, both of which are completely free products to use, is inherently bad for consumers. Likewise, I'd say with Alphabet, you look at Maps, YouTube, Gmail, Search, Chrome, Android, all that integrates together. Consumers like it. They like that these things all talk to each other. It makes for a better experience. And all those products are free. So I think it's hard. It's easy political rhetoric, but I think it's hard to actually show that there's harm. Even if there was harm, you break some of these things up, and it's not clear to me that it's a negative. So I think YouTube, for example, might actually be worth more if it wasn't part of Alphabet, because there are a lot of people who don't want to partner with YouTube because it's such a big part of Alphabet. You put that together, and then even with the rising compliance, and Facebook is investing heavily in platform safety, security, stability, which they should. And you've got things like GDPR in Europe, California privacy law. All this is really increasing costs, but it's also increasing barriers to entry. And for the incumbents who have the most data, the deepest pockets, does it make it harder for them to deliver an attractive ROI for marketers? Yes, but they still have the best seats in town, and they're still able to offer the best ROIs, and it's getting harder for other people to enter. So, I think regulation is a double-edged sword. Everybody's focused on the negative, but there are positives of that as well. Monster Beverage has been a phenomenal performer over a very long time. The business is very capital light, so basically they make the syrup. Coca-Cola is a key bottling partner for them. I think part of the reason Monster's been such a big success is that it serves a part of the market that people aren't paying much attention to. So Monster, it doesn't speak to investment bankers. It doesn't speak to people working in the CBD. It speaks to young guys who have hard jobs and they want a big, affordable, cold drink that's going to give them energy to get through the day. And just like how I'd say Walmart for a long time was overlooked by Wall Street and kind of derided for serving a clientele that wasn't fancy, Monster's core clientele is not fancy, but it's growing. And energy drinks as a category have been growing for a very long time. Monster's been gaining share within that because it's an attractive value proposition. And they've executed really well. I think that they're also, the core Monster brand is driving most of the profits today in the US, but they've been moving into a lot more markets and widening distribution. I think that's really attractive. I also think that there's potential for this to get acquired at some point. So Coke owns close to 20% of it. And if you step back and look at some incentives here, Coke's volume is their volume growth is very low. They're acquisitive. Energy drinks are growing. Monster is growing quickly within that. Monster's two leaders of the business. They're not quite co-founders, but the two guys running the show are getting on up there in age. May not mind a liquidity event. You kind of put all those things together, plus they already have a strategic agreement between them, and I think there's a good chance that Coke steps in at some point to own this business outright.